In this piece, I want to talk about how on earth are we going to reduce our mortgage interest? Surely we can't be doing that, but yes, there is. There's a product out there. You see on the top line of my screen, it's the offset mortgage. Yes, I know it's not new, but there has been some innovation. There's been some new lenders come into this market. And therefore, as a broker, I've seen more and more, not only homeowners, but landlords jump onto this bandwagon. Why wouldn't they? If in their circumstances, they could save money, reduce the interest of paying on the mortgages. It makes absolute sense. So I want to share that with you guys today and explain how you might benefit from this type of product. First of all, let's do a little bit of a rewind. For those of you that don't know how offsets work, it's quite simple. You've got a mortgage, let's call it a jar or a pot, a mortgage pot. You're borrowing £100,000. If it's an offset mortgage, then the lender also issues you with a savings pot. And the two pots are by the same lender, and therefore they are linked. They're separate but linked. So if you're borrowing 100K, and you've got, let's say, £10,000 in your savings pot, then the computer recognizes, of course, there's that money in the savings pot. The money is not moved. It's not reducing the balance of your mortgage that you owe. You still owe 100,000 quid. However, the interest you pay on that mortgage is not on 100,000. The computer goes, you've got 10 grand in your savings. We'll charge you interest on the net figure, £90,000. So therefore, you're paying less interest. And when you take your money out of the savings, it gets adjusted on a daily basis. So it's a very fair basis and set up in that way. Now, you might be shouting at the screen, what do you mean spare money? What do you mean, this extra £10,000 that I don't need? And I get that money for all of us can be quite tight. But I want to sort of challenge you about what I mean by surplus money. I'm not talking about profits that you don't know what to do with. I'm talking about your contingency money. That rainy day money that you've got to one side that you would not be spending on repairs and maintenance and living. It's not your working capital. It's over and above that. Now, if that is in your current account, if it's not working for you, then of course you can put it in this offset account, just have it sat in that jar, and now it's working for you. Do you have a trading company where you pay VAT over quarterly? If you are used to paying VAT, then you'll be putting that money to one side, hopefully, and then every quarter pay over to HMRC. I suspect that money is not working for you. Usually it's just in your current account, or maybe off to one side in a savings account, but earning very little. Whereas now, if you put it in an offset, that money is working for you at 4, 5, 6%, because that's what your mortgage rate's likely to be. What about your annual tax bill? Do you put money to one side for your annual tax bill? Again, trying to be smart about these little pots of money that you can aggregate and put into that offset account. And the final thing is working capital. Now, this could be a little controversial here, particularly if you're a limited company owner. And it does sometimes depend on the accountant that advises you. But I would certainly have a conversation, maybe even challenge your accountant. If you're a limited company owner and you've got I'm going to say surplus funds in your limited company account. I personally, because I do this, but I see no reason why within your accounting year, do not ever cross accounting years with what I'm about to say. Taking money out of the limited company and putting it in your offset account, as long as you then put that money back into the limited company before the year end, then it wouldn't be treated as a director's loan. Certainly as it crosses the year end. And I think actually if it does cross year end, your accountant is then meant to say, well, it has to be taken as dividends. And of course, there's all the tax implications. So as long as you're putting that money back, there's a nice clear audit trail. You're taking X pounds out of your limited company account, put it into your personal account, and then put it back. There might be some accountants out there that say that you shouldn't be doing that. And that's fair enough. Take your advice from your accountant. But my accountant, and I'm doing this, is that I'm taking that money out of the limited company as a director's loan to myself, but then I'm paying it back before the year end, 0 interest. But in the months that I've taken it out of the limited company account, because I don't need it on a day-to-day basis and it's not really working for me, I can be making that money work really hard and smart for me and saving me all that money. So look, I'm hoping I'm giving you some food for thought here about how you can use perhaps spare cash and use it in an offset type environment. Now, the innovations come with the new lenders coming in, because you can be making these savings in an offset account even if your mortgages are in a limited company. Historically, these have only really been available if the mortgages have been in personal name. So now we've got that added opportunity to have an offset even if you've got a limited company mortgage. And as I've said on the 4th bullet point, as a landlord, if you've got buy-to-let mortgage or a HMO or a holiday let mortgage, then potentially that's still applicable and you'll be eligible for an offset mortgage for those types of mortgage products. So the takeaway message is talk to your broker, understand what sort of products, what interest rates are these buy-to-let offsets looking like, and then tell your broker the sort of savings that you might have on average, and he or she should be working out. Yes, you've got a headline rate of, let's say, 5%, but if you've got X pounds in savings potentially over a year, then your broker will say, well, that actually means an effective rate that's substantially lower. And that could be the best news you've heard. Rather than paying that headline rate of 4, 5, 6%, you might be paying 1, 2, or 3%. How smart is that? So if you want to chat certainly to us, then there'll be a link below this piece that takes you through to our diary, and just have a chat with the team. Ask them about offsets. Is it right for you?